Dear investors, on behalf of SBI Funds Management, let me extend our heartfelt gratitude for your unwavering trust and steadfast support. As we celebrate the remarkable 7-year journey of our ESG PMS, we recognize this as a pivotal juncture to engage in a meaningful conversation with Gaurav Mehta, the CIO of the SBI Alternatives business. Our aim today is to take stock of where we are coming from and where we are headed, something we promise to do more often as we go forward. So, most of you already know Gaurav, but for those who haven't yet met him, he's, of course, the Chief Investment Officer of our Alternatives business. And before this, Gaurav managed the SBI Retirement Benefit Fund as well as co managed the Balanced Advantage Fund. At SBI Funds Management, he heads the Asset Allocation Committee, where he serves as the Chief Strategist of the investment team. So, Gaurav, today I intend to not be a colleague, but to step into the shoes of our investors and to ask you, some of the questions that I guess are on their minds. But, let's start with the big picture first, right? Because on the one hand, we are seeing that for the Indian market, the valuation is, still quite expensive. On the other hand, we are seeing that there's a lot of capex, this whole make in India, because of which it looks like earnings are going to be robust. So if we were to take, say, a 3-4 year view, where's the market headed?
You're absolutely right, Sumaira. And I think, if you look at the markets over the last 2 years, we've been broadly consolidating. So Nifty hit a high of 18,500 or some such number in August of 2021. And today we are at 19,500 or thereabouts, right? So over the last 2 odd years, we've only risen by 5%, which in practical terms is nothing. And exactly these two forces have been playing, a tug of war, so to speak. On one hand, valuations are expensive, but on the other hand, India is the only sort of large economy in the world that's offering some glimpse of recovery and manufacturing and all of those things, and finally coming in place at a time when the global economy is in such a bad shape. So I think from that point of view, slightly higher valuations are warranted. And I think from longer term point of view, I think one thing that investors should keep in mind is the fact that profits to GDP in India are still emerging from a decadal low. And I think profit cycles in India last for several years. You had a period from 2000 to 2008 when you were in a profit upcycle where profits to GDP constantly rose each year. 2008 to 2020, you had a 12 years of earnings drought where profits to GDP constantly came down. And now only over the last 2-3 years have you started seeing a recovery in profits to GDP ratio. And usually, as I said, these trends last for a few years. So for an investor who's looking at a 3-4 year time frame, valuations, just like the sideways consolidation of the last 2 years has ensured, maybe there'll be some more correction, some more consolidation, and valuations will take care of themselves. But the bigger picture is that from a 3-4 year point of view, you are in early stages of an earnings expansion cycle, and when earnings are robust, everything else becomes relatively sort of secondary. So this is no comment on what's going to happen in the immediate near term. But a 3-4 year investor, I think from an earnings point of view, we are still in good shape.
So it's been 7 years of the ESG PMS, right? And touch wood, it's been a good 7 years. So what should, from an investor's point of view, what should be the strategy now? Should they look to keep adding? Should they look to book some profits or just remain invested as is?
I think as we just discussed, right? When you think of equities in general in India, the next 3-4 years, you are in potentially an earnings expansion cycle. But when you think of the ESG PMS per se, I think overall, if you think of the construct of this PMS, you're focusing on two things. A, you're being market cap agnostic because size is small, so you can buy mid cap, small cap companies. And so this is actually a multi-cap strategy where there's almost a one-third representation to large, mid and small caps. The other thing that you're doing is that because you're integrating this layer of ESG, companies which are environmentally aware, which are socially conscious and which are following good governance, that in a way brings in a layer of sustainability. So, mid-cap, small-cap companies are supposed to deliver good returns because they are businesses which are relatively not so mature early on in their life cycles. But then the challenge with small-cap investing is that there are lots of accidents as well. But when you bring in a degree of or a layer of sustainability, which the ESG strategy does, then you're in a way ensuring that you get the good benefits of small-cap investing while also avoiding accidents that come along the way. But overall, I think the portfolio construct is such that you're more focused on sustainability and long-term returns rather than here and now. And the make of the portfolio is such that the overall beta is low. The companies are not very financially leveraged, so the debt equity ratio is low. So what tends to happen, and investors who have stayed invested with us for longer periods would know that maybe in rising markets, you don't look like some superstars in terms of portfolio performance. But in a falling market, because you have a quality bias, you have a growth bias, the beta is low, you also tend to not fall as much as the index. So, yes, today there are pockets in the market that look a little stretched from a here and now basis. But I think this is a portfolio where you're much more focused on sustainability and consistency of returns. So I would personally not think that there is any reason for long-term investors to be worried about. They should stay invested and they should continue following a systematic plan to keep adding to their equity investments.
Okay. Um, you know, this portfolio, like any portfolio, naturally cannot be static. So there have been changes, there will be changes. What are these changes predicated on? What is it that helps you decide, which stock position you should scale up, or what stock position do you exit? What are the levers that you work on?
Interesting question. So, overall, as I said, this is a portfolio which is very much focused on sustainability and long term. So the churn typically tends to be low. So, I don't want to give a number, but typically, it's much lower than a conventional long only product. That said, yes, there are reasons where we have to sell our existing investments, and I think I'll categorize them into three broad buckets. The first is when we have misread the management or there is change in management behavior, which makes that investment ESG unfriendly, right? So either governance becomes suspect or there's something on environmental social front that changes. Whenever there is a change there on whether we've misread the management or the management behavior has changed on the ESG parameters, we'll immediately reflect that and get rid of such investments. The second layer of exits happen when there is a discontinuity in business. So the business trajectory, the way we envisaged versus the way it's playing out, which can be because of disruption or any other sort of company specific factor. If we think that the long-term thesis doesn't hold any true any longer, then we will make course correction and exit. And the third layer of exit is when, and this is not something which happens very frequently, but is when, valuations have run up so much ahead of fundamentals that even with your assessment of the management quality, of the business performance, of the earnings compounding, you think that from such valuations, the forward-looking returns are going to be very meager. In those cases, again, you want to exit these companies and make way for better opportunities. I think those are the three buckets: management, any discontinuity or disruption in business, or expensive valuation when they get so exorbitant that the forward return expectations come down meaningfully, are the three reasons why we would have sold what we sold in the past.
Okay, and what would you base your scaling up the position on? The converse, is it like maybe valuations become more attractive or better strategy than what you could have envisaged?
Right. So I think overall this is a very concentrated strategy. So at any point we don't go beyond 25 stocks. I think as we speak we would be somewhere around 20 to 23 stocks, and as a result, an average stock holding tends to be about 4-5% of the portfolio, if not more. So we tend to start at least at 3%, even for smaller ideas, around 5% for larger names. And then as we keep getting more conviction, either valuations become very favorable without any change in the fundamental thesis, or for that matter, the same three things that I talked about, right? The business trajectory turns out to be much stronger than we initially thought, or the management articulation and the management strategy is much better than what we initially thought. In all three cases, we would want to scale that position up. But on an overall basis, 5% is the neutral position. We seldom start at less than 3%. And I think on the way up, there is no constraint except for a risk constraint that we don't go beyond 10% in a particular holding. So I think that's the, that conviction. As we keep building on to the conviction in a name, we, sometimes keep scaling up the position.
So, ESG per se, if we look at it globally, there's no doubt that it's one of the big themes out there. In India, what is the status of ESG? Is it a theme whose time has already come or is yet to come? And in terms of our own ESG PMS, what is the future as you see it?
I mean, I would sort of start by having a fundamental disagreement. I don't think ESG is a theme. At least the way we approach ESG, we don't think of it as a theme. A theme is something which works in a certain cycle and which doesn't work in a certain cycle and so on. For us, ESG is, as I said earlier, integrating a layer of sustainability. And the ESG process we follow, for example, in the PMS, is not to buy best-in-class ESG companies from all sectors. So this is not a portfolio concentrated in renewables or in hydrogen or in wind and solar and so on. For us, ESG is eliminating sectors and companies which are non-ESG in nature. So there is a certain set of sectors which are non-ESG, like tobacco, fossil fuels, etc. We exclude those sectors, and then from remaining sectors, there is a certain minimum threshold on ratings that we follow on ESG. Companies which are below that threshold, again, we remove those companies. So, essentially we follow an exclusion-based ESG strategy. But after making these exclusions, we would think that, maybe 1/3 of our research coverage gets eliminated. The remaining 2/3 is still there for us to pick and choose companies on bottom-up fundamentals, which is management quality, profitability, growth, valuations, and so on. And eventually, we're just buying less than 25 companies at any point in time. So the outcome is still very well diversified across sectors. So, for us, ESG is eliminating unsustainable businesses so that, whatever you're left with is sustainable. And especially when you're, investing in mid and small caps, I think sustainability has to be the core of it. So, long answer to your question, but for us, ESG is not a theme. It's a way of investing that ensures sustainability in the portfolio. And as a result, there is no good or bad time for sustainable investing. Sustainable investing was the only way of creating long-term wealth in the past. That is the only way of creating long-term wealth today. And I think in the future also, that simple fact will stay.
Okay, so the strategy basically is evergreen, right? Sustainable is the way to go. But Gaurav, now there are so many PMSs out there, right? And a lot of them have very, very big names attached with them. What makes the SBI ESG PMS stand out?
So I think there's no right or wrong way of going about it. But when you're thinking of an institution like SBI, you're not just investing in a product, but you're investing in the entire ecosystem as an investor, because we boast of one of the largest investment teams in the country, and these are people, on research, for example, we have people who have had 15-20 years of relevant sector experience. They are CAs, CFAs, or similar sort of qualifications. And to the extent that they've been covering these sectors for so many years, their understanding, their in-depth research ability is significantly higher. So I think that big investment team comes in handy even on the alternatives platform, because eventually the research team is shared. But I think what SBI brings to the table, it goes beyond the strength of the investment team, to the extent that there is a proper risk and compliance framework in place, supported by the respective teams. There's a proper operations team and a big support there as well. And again, PMS is a product where during the sales process and the after sales process is very important. And to the extent that you have such a big, large sales network across the country, I think that also allows that ground connect when it comes to that the sales process and the after sales process. I think both of which are very important for investors. So I think SBI as a brand inspires trust, and when it's supported by a full ecosystem, I think there are definite merits for investors, which I don't want to compare it with anybody else, but I think it's definitely a tangible benefit.
Okay, so it's not just about the returns, but the entire investing experience.
Absolutely.
Gaurav, thank you very much, and we're going to keep coming back to you. I hope this chat continues at least once every quarter, and we'll get some more questions from our investors, and we hope you'll indulge us.
Thank you so much. My pleasure.
Thanks very much.